In today's episode, I'll talk about three stories. In the first story of the day, I'll talk about the cement sector of India and what it really tells us about the broader Indian economy. In the second story of the day, I'll talk about a recent controversy around United Breweries and the Telangana government with respect to beer prices. And in the third and final story of the day, I'll talk about a legal dispute over Reliance extracting gas that migrated from ONGC's fields. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 18th of February. Let's begin with the first story of the day. See, two of the country's largest cement producers, UltraTech Cement and Adani Cement, have recently announced their results for the third quarter of this financial year. Now, cement is one of those industries which people sometimes overlook, yet it is actually the backbone of nearly all building and infrastructure work that happens in our country. Whenever you look at roads, bridges, airports, or houses, you will find cement at the heart of it all. And that is why the performance of all of these companies usually gives us a great idea about where the broader economy is headed. Now, UltraTech Cement is a part of the Aditya Birla Group and it is the biggest cement producer in India. It has plants all over the country, north, central, west and the south. Its capacity is at about 171 million tons per year or MTPA, and it also recently bought the cement divisions of India Cements and Kesoram Cement in order to make itself even bigger. Now, their plan here is to cross 200 million tons by the financial year of 2027, which is a huge bet on the idea that India will need a lot more cement in the coming few years. Now, during this particular quarter, UltraTech Cement earned about 16,900 crore rupees in revenue, and this is only a little bit higher than the same time last year. But the thing is, it is much better as compared to the previous quarter. The company's sales volumes went up by around 11%, which is faster than the cement industry's average growth of about 5%. But there is an interesting twist in these numbers. Even though revenue went up, UltraTech Cement's net profit actually went down by about 17% compared to last year. A part of the reason is that costs, especially for fuel and freight, shot up. And I'll explain how. See, cement companies usually rely on things like pet coke, thermal coke and diesel, all of which were more expensive for much part of 2024. UltraTech did try to lower these costs by making its distribution routes shorter, but it could not really escape the price hikes completely. Still though, by the end of the quarter, UltraTech Cement started seeing some relief here. Fuel prices came a bit down and the company began getting better prices in the north and western markets of the country. Now, there was also stronger demand in the month of December, which is when a lot of projects finally kicked into gear after months of slow activity. UltraTech's management believes that this demand is just the beginning. They expect government spending on infrastructure to pick up, which might mean more roads, more highways, and public works needing cement. They also think that rural markets will keep growing since farmers tend to build and renovate homes after the harvest season, which is when they have better cash flow. Moving on, let's talk about Adani Cement, which is a second big player in this story. Now, Adani Cement as well brings together two older cement brands, which is ACC Cements and Ambuja Cements, which once used to be owned by a company called Holcim, and it has also been adding plants from Penna Cement in the south and Sanghi Industries in Gujarat. So altogether, Adani's cement capacity is about 90 million tons right now, and its quarterly revenues were about 9,300 crore rupees, which is about 15% higher than the same time last year. Their sales volumes also went up strongly, which means it sold more cement than they did before. Also, interestingly, Adani Cement's net profit jumped by a huge 140% this time around. A part of this spike happened because the company recognized some government incentives all at once. Now, these incentives are usually linked to expanding capacity and other state-level projects. They can show up unexpectedly and they don't necessarily repeat every single quarter. And this makes the profit numbers look a little extra stronger in some quarters, and they actually might look less dramatic in some other quarters. Adani Cement's revenues improved mostly because of higher volumes this time around. Just like UltraTech, it saw that stalled infrastructure projects started picking up from December onwards, and rural housing in North and Central India stayed fairly steady. Now, sales in the southern region were not really very strong, but overall speaking, the company managed to get slightly better prices for its cement as compared to the previous quarter. Now, both UltraTech and Adani are pushing very hard to add more capacity. They believe that cement demand in India will keep rising. Part of it is due to more government spending, and a part of it is because our country's real estate and infrastructure needs are massive. UltraTech, for example, wants to reach about 210 million tons by 2027, while Adani Cement is working on a series of expansions and optimizations in order to serve not just regular market demand, but also the wider Adani Group's own projects across different sectors. So as these bigger companies buy up more plants and merge different cement units, there is a lot of behind the scenes work to align operations, overhaul machinery, and sort out their own branding. And this, of course, can cost money in the short term, which is why you might see some uneven performance from newly acquired plants. But the thing is, once these new units are upgraded and they become more efficient, the companies expect them to contribute very strongly to their overall profits. And a big part of the reason why this is important for us to know is because the Indian cement industry has currently been going through a phase of consolidation. See, over the past several years, many smaller or regional producers have been acquired by larger groups. So a handful of big players are now controlling a larger chunk of the market. UltraTech and Adani Cement, between them, already account for nearly half of India's total cement capacity. And this consolidation can sometimes help stabilize prices and also reduce wasteful competition, since bigger players can be a little more efficient. The year 2024 got off to a slow start for the entire industry, with overall volumes rising by about only 2% in the first half. Government infrastructure spending was more subdued and some projects were put on hold. But by December, the pace began to pick up. Many people in the industry are now feeling optimistic that the remainder of the financial year and beyond will see more robust growth thanks to increased government spending on public works, a rebound in commercial real estate, and steady demand from both rural and urban housing. With that, let's move on to the second story of the day. Do you know Telangana is one of the largest beer consuming states of India? Now, recently, they increased their beer prices by 15% after a long, ugly, and a very public confrontation with United Breweries Limited, or UBL, which supplies Kingfisher and Heineken beer to the state. But the question here is, what is the entire fuss all about? Why is Kingfisher fighting a state government? And why is the state government setting beer prices in the first place? That is exactly what I'm going to talk about in this story. But before we get into the details, let's first understand how the alcohol industry in Telangana works and how exactly it is different from the other states. See, Telangana exerts very strict control over alcohol prices as compared to the other states. Ordinary people like you and I cannot really enter the business of distributing alcohol easily. Instead, there is a full-fledged government entity called the Telangana State Beverages Corporation Limited, or TSBCL. And this company has a monopoly on the wholesale of beer and IMFL, or Indian made foreign liquor, in the state. Now, since the government controls all the sales in the state, they also set the prices for it. And for this, they set a maximum retail price, or MRP, on alcoholic beverages. And this price is binding. If manufacturers do not like it, their only choice is to not even sell in the state at all. And I'll tell you how it works as well. See, first, breweries or distilleries propose an ex-brewery price. Now, this is the cost at which they will sell to TSBCL. Second, these pricing suggestions are sent to a 3-member price fixation committee. This committee basically reviews the price after considering cost structures, inflation, and also pricing in other factors of other states. If they find that the proposed prices are acceptable, they approve them. Then comes the third point. The government then finalizes an MRP after accounting for excise duties, distributor margins, and also retailer margins. Now see, as far as alcohol buyers are concerned, TSBCL is the only buyer of alcohol in their state. And this sort of makes them a monopoly and gives them tremendous pricing power. The state liquor depots that they run are the only places where a manufacturer can make a sale. It is then TSBCL and not manufacturers that sell alcohol onwards to retail outlets. And the overall idea behind this model is basically to make alcohol prices predictable for consumers like you and I. But if you think about it, that's pretty odd, right? Why would a government really care about what people pay to get intoxicated? And also, why would they even care so much that they have built an entire liquor distribution system? See, that's where the entire issue lies. One could very well argue here that the state is trying to prevent profiteering and they want to keep alcohol affordable for those people who choose to drink it. Because after all, if it becomes too expensive to drink legally, people actually might turn to all sorts of alternatives, including illegal liquor, which could hurt their health terribly. But the thing is, there could also be something a little more interesting that's happening here. See, the Telangana government relies heavily on taxes from alcohol sales. In fact, Telangana earns 36 to 40,000 crore rupees every year from liquor sales and monthly license fees that is collected from liquor dealers. Now, this makes it one of the largest sources of the state's revenue. And for that, the state sells 45 to 55 lakh cases of beer every month, even more than they sell hard liquor. And for this revenue to keep coming in, you obviously need more alcohol sales. And keeping liquor cheap does exactly that. You see where this is going? See, the problem with Telangana's complicated alcohol pricing system is that it comes with significant downsides for manufacturers. And that is precisely what we saw playing out over the last month or so. For beer companies like UBL, which by the way owns Kingfisher and Heineken, the Telangana pricing model creates serious profitability crisis. Now, one thing you need to know here is that Telangana is really big for UBL. The state contributes 18% of its volumes and 15% of its revenues. But despite this, doing business in the state has become increasingly difficult for the company. The state had not revised the cap on beer prices since 2019-2020. But on the other hand, raw material inflation, which is the prices of things like barley, glass bottles, logistics, etc., has surged quite a bit in these years. And second, Telangana's ex-brewery price has been among the lowest in India. And as a result of this, UBL earned just 300 rupees per case in the state compared to 500 or even more in northern neighboring states like Maharashtra. And on top of all of this, the state government has often lagged in paying its dues to alcohol companies. For instance, the state government owed more than 3,600 crore rupees to beverage companies in unpaid dues, including 658 crore rupees to UBL as of January 2025. Now, this added to the already strained commercials of selling alcohol in this state. So manufacturers basically face squeezed margins, unpaid dues, and no price revision at all. So in a sense, their earnings were lowered artificially, at least when compared to other states, and on top of that, they weren't paid that lower amount as well. And therefore, in January, UBL took a very drastic step. It halted its beer supplies entirely to TSBCL. And this was a big deal because when a company like UBL, which controls about 70% of Telangana's beer market, refuses to supply a popular beer in a state that sells huge volumes of beer every month, the government can come under pressure. Because after all, while the government might broadly want to keep alcohol consumption under control, it also has to ensure that manufacturers stay interested in selling in Telangana. And if companies like UBL start walking away from the state in order to reduce their supplies, that could create liquor shortages. And not only would that upset consumers, it could also lead to a massive loss in revenues. So recently, after a lot of back and forth, the Telangana government gave in and hiked the prices of beer by 15%. Now, this was still not as much as the United Breweries was asking for, because after all, their costs have gone up significantly over the last half a decade. But even after the 15% hike, margins in Telangana still remain lower than that in Maharashtra, Karnataka, or even UP. They had asked for a 33% hike, but with that said, 15% was still the single biggest jump in beer prices that the state of Telangana had seen in a really, really long time. So now the question is, where do we really go from here? See, while the United Breweries may have gotten some temporary relief from this 15% price hike, this is only a temporary solution. The involved parties also call it an interim arrangement. The state's deeper problems still remain. Because Telangana's rigid price controls and state's monopoly over alcohol distribution may quite provide predictable revenue for now, but the core issue still lies in the government's dual role as both a regulator and a trader here. And as a result, their incentive is to control alcohol consumption and curb illegal liquor sales. But also as the sole buyer and distributor of alcohol in the state, they are also incentivized to prioritize revenue, supply, and stability in prices. The competing objectives are bound to confuse and also distort their decision making, which is what we are seeing currently. And this of course results in delayed price revisions, payment backlogs, and strained relations with suppliers like United Breweries. So, in summary, while the government may have temporarily avoided a crisis for now, unless they start to rethink their broad approach here, these situations will certainly keep coming back, which of course is not good for any of the involved parties. With that, let's move on to the final story, which is about a controversy surrounding Reliance. See, last week, the Delhi High Court set aside an arbitration award that had earlier favored Reliance Industries in a massive dispute worth about 1.7 billion US dollars. But in order to understand why exactly this happened, we need to very quickly rewind and see how Reliance, which is India's largest private company, and ONGC, which is a public sector oil and gas company, ended up in a confrontation over natural gas extracted from adjacent blocks off the coast of India. Now, this is a bit of a complex story which involves overlapping underground reservoirs, government contracts, and the question of who truly owns the gas beneath the ground. See, all of this goes back to the year 2000. At that time, Reliance and a partner company called Nico Resources received the rights to explore and produce gas in an area known as the KG-D6 block in the Krishna Godavari basin. Right next to it lay two blocks operated by ONGC. Now, for a while, nobody realized that these blocks were connected underground. But in 2009, when Reliance started producing gas from its block, it began drawing out not just the gas that belonged to its area, but also gas that had drifted in from ONGC's blocks. You can almost look at it as if there was a hidden pathway below the Earth's surface that allowed the gas to travel across boundary lines. Now, because ONGC had not yet started extracting gas from its own blocks yet, it took a few years for the problem to be noticed. In 2013, though, ONGC's internal checks indicated something strange was happening. They suspected Reliance was siphoning off gas that rightfully belonged to ONGC's fields. Rather than directly accusing Reliance though, ONGC turned to the Indian government for help, saying that Reliance had effectively sold gas that did not really belong to themselves. The government then brought in an American company called DeGloyer and McNaughton to study this matter. Their findings confirmed that between 2009 and 2015, a large amount of gas flowed from ONGC's blocks into Reliance's block. Now, out of this, Reliance had already produced and sold most of it. Now, according to Indian laws, all underground hydrocarbons belong to the government. Companies like Reliance and ONGC can only produce gas that are within the boundary of those blocks that the government has given to them. So while Reliance had not maliciously set out to steal ONGC's gas, it has still taken gas it was not really entitled to. And the government stepped in and demanded $1.7 billion from Reliance in 2016. But this triggered one more problem. Reliance had a contract with the government which stated that any dispute over gas production would not be settled in regular Indian courts, but would be settled through an international arbitration process. And that is why this matter ended up before a tribunal in Singapore. And in 2018, this arbitration panel decided by a majority that Reliance did not owe the government anything. They said that Reliance had the right to extract any gas within the limits of its blocks, and if the gas from elsewhere migrated naturally, Reliance could still take it. Now, the Indian government challenged this decision in the Delhi High Court. Earlier this year, a single judge in the High Court agreed with the arbitration tribunal and refused to interfere. But last week, a two-judge bench in the High Court reversed that. The judges observed that natural gas is a precious resource that is held by the government for the people, and that the arbitration panel had not given enough importance to this point. So now the $1.7 billion claim stands once again, and Reliance has said it plans to appeal to the Supreme Court about it. Now, although this case has been going on for many years now, it highlights a very important issue. Managing shared underground reservoirs is not really simple. The earth does not really respect the neat lines that we draw on all our maps. Across the world, such problems are often handled with unitization agreements where everyone works together to develop reservoirs that are connected so each party gets their fair share. This dispute between Reliance and ONGC has basically shown that India may need better rules to deal with such situations. Meanwhile, ONGC only started from producing its blocks earlier this year, so a great deal of that gas might have already been extracted. The final outcome now rests on the Supreme Court's decision, and whatever happens next will very likely shape how India basically tries to deal with such similar disputes in the future. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.